All right. Hello, everybody. Thank you for tuning in. I apologize for my tardiness. I am about 15 minutes late. So let's get going here. Today, we are going to be talking about SDE. And I didn't spell it wrong. I didn't mean to write the word side or anything and miss the I. Okay, SDE is the seller's discretionary earnings. And so we're going to talk a little bit about that and why I'm looking at that and why that's something to consider. So before we get going in, I just want to put out there that before you take any of the comments and suggestions that I put out there, please go and check with somebody else. Yeah, it may not be the right advice or direction for you. So please take it with a grain of salt, as every single investment sort of has their own risks. Okay, so part of the reason why I do these Money Matter Mondays is so that fellow accredited investors can make sound decisions on their investments and, hoping to connect with fellow investors. Okay, so we will get going with Money Matters today. So we will look at the seller's discretionary earnings, okay, SDEs. And then what we're also going to do is a question came through from last week's video, and it's a bunch of questions. So we'll tackle that right now before we get into it. So the question that came in from last week's video, when we were talking about what was my largest gains in real estate, like what strategy was that from? So a comment came in, and if you want to make a comment on any of my videos, please do so. You can either do it on Facebook or directly in YouTube. Okay, so here's a question. On your private lending, where your promissory notes backed up by security and like a mortgage in your favor and act as a mortgagee, have you used other securities to back up your capital, like pledge of shares? Did you ever have borrowers that did not pay you back, and were you able to get your cash back? So a lot of questions all string together, but they're all linked together in some way. So yes, I have done private lending. So private lending for many years has been a big part of my income to pay for my lifestyle. So I would do very creative. I have done very creative ways of lending out my money, in the sense that, okay, I would lend out 100,000, 200,000, whatever amount, in exchange for shares or equity in a project. So that is definitely an idea that I still support and still think is a great idea, because now you're getting, potentially a little bit of interest on that money, whether it's 5, 7, 10%, okay, there's still some interest if you can negotiate that, and along with an equity in a business. So this isn't only in real estate that we see this, like, Alanis Morissette did this with one of her concerts. Like, instead of getting paid, she took shares in the company that hired her to do the concert at their corporate event, right? So it's sort of the same idea here. So trading, time or resources for equity in a company or a business. So yes, I have done that. And have I done P notes? So yes, I do P notes, but not very often. Okay, I've maybe done 2 P notes in my entire career. One was with one of the accountants that I had, so I know my accountant's not going to like take off, take off with my cash. And also, it was for the expansion of his business, and so I sort of believed in him, had a really good relationship with him, and so I trusted him to that extent of being able to lend that cash for him. That deal, I actually made money on it, right? So it wasn't like free money. I was just giving to somebody that I knew and trusted. And then another one, was on a big land development deal. So have I had people default on borrowing? Yes, absolutely. Like, I've lent money out on businesses and real estate, and the 2 or 3 that I did on businesses were my very first ones. And after 100% default on those ones, I'm like, never again am I lending on a business unless I have some other security, unless I have some other collateral. Okay, so I don't just put money into a business and then not expect anything back, especially if it doesn't have real estate tied to it. So if the borrower goes on default, Are you able to recoup some of the cash? Yes. So what you can do is if they go in default, you can foreclose on them. You can go and chase them personally if you've signed a personal guarantee on that loan with them, even if it's a promissory note. Okay, so it depends on the amount, it depends on the level of effort you want to put into chasing somebody for the money. So that is something definitely you want to go talk to your lawyers about, because you do need to go through a lawyer, you know, those collection agencies, all of that stuff. I would definitely highly recommend you do not do a P note unless you can take the risk of losing 100% of that cash. Even if you secure it against the property, if they go into default, you could potentially lose 100% of the cash. So that's my warning there. Okay. So there's tons and tons of situations happening right now around promissory notes. So just be very aware of that. Okay. So thank you, Mark, for sending that over. So I will go into now the seller discretionary earnings. Okay, so this one here, so if you're asking what an SDE is, okay, it's basically money expenses reported in a financial statement where the current owners is saying, hey, this is how much we spent on expenses. This is how much we spent on paying ourselves. There's money that is part of the business, but if you are a new buyer coming in, that money, that expense doesn't necessarily apply to you because you can adjust those. Those are not fixed expenses. So I'm right now looking for hotels, RV campgrounds, you know, an alternative business for myself to get into. And so one of the things that I always look for when I look at the financials is, what is the seller's discretionary earnings? What's the number that they have on their expenses that they say they have that I can now get access to because it's income coming in and it's extra funds that are available to pay yourself, pay for cars, pay for, you know, other related expenses that may not be so much business related anymore. Okay, so let me bring up the Excel sheet and let's walk through some of this, because I think in terms of numbers, and having the an Excel sheet definitely helps with that. So let's see here. So let's share this blank Excel sheet. Now I can't share any of the, what do you call it? The actual documents that I get from any of the businesses because of all the non-disclosure forms that I've signed. Okay, so on your screen, you should see a blank Excel sheet. So let's go into that. Okay, so let's just say a business, you know, they have income and it could be from multiple sources. Okay, so whatever that source is, okay, let's just say it's $1.5 million. Okay, and then you have your expense line. So we're just making this very, very simple here. So let's just say, you know, there's a bunch of expenses, and then you have your utilities, you have your property taxes, and then you have salaries, especially with like a hotel, campground, stuff like that. There usually is some sort of salary that goes with it. Let's see, and then vehicles, so cars, and then office supplies. Okay, and then the debts, like any sort of mortgage, private lending, and all that stuff that's on it. Okay, so let's just say for the year, yeah, so this is annual here. Okay, so the utilities, let's just say it's $7,000. Okay, so what there would be is there would be some sort of personal usage that could potentially come out of that. Okay, so you would see some sort of what they call normalization on these financial statements. And this is a percentage that the seller has said, hey, you know what, this is for personal use. So it's really, we're claiming it as an expense, but you as the new buyer here, you may not have that, okay, if you don't want to claim it. Okay, so let's just say that's 10% here. So I'm just going to pick a random number here. So we're timing this out. Okay, so that's $700 there that they're taking out. So once we normalize it, it's 7,000 minus the 700. So really, this is what it's called, the normalization. Okay, so I'm going to go stick with the same terminology here. Okay, so really the true expense as the new buyer coming in, I would really only be claiming 6,307 instead of the 7,000. Okay. All right. So the property taxes, let's just say, I don't know, 10,000. Okay. So here we're going to just go like that. Okay. So then the salary that they've given out to their staff, let's just say it's 350,000. Okay. And we can sort of check all of this afterwards. So let's just say now we're going to take out 35%. Okay. So what that means is they're paying themselves $122,000 as a salary. So the owner is working in there and they're paying themselves $122,000. So me as the new person coming in, I could say, yeah, okay, I'll keep going with this. Or I can say, nope, you know what? I'm not going to pay myself that much. I'm going to pay myself only $100,000. Or I could say, nope, I want to pay myself way more than that. I want 200,000. Okay. So then this number would actually go up. The percentage would go up. So then the cars, let's say there's like a $780 lease on a car. And some people would say, you know what, 100% of that, that's entirely up to you if you want to take that car. So they would take out 100% of that. The supplies, let's just say it's $250 for the year. And then the debt, let's just say $45,000 for mortgages, private lending, whatever. Okay. So what they would do, oh, and then they also do income tax. Okay. That might be in there as well. So let's just say there's 3,200 there. So this would actually take the income tax part, they would actually take that out. This income tax is different from property taxes. The income tax is what the company would pay for their filing and then GSTs and all that stuff. Okay, so 100% of that usually they would take out because it's dependent on the new person coming in. Okay, so as you can see now, so now the car is at $0, the income tax is at 0. Usually they would also take out the debt as well. Okay, so that means now, so let's just say we go here and we're saying, okay, the sum of all of the expenses on this property right now is $416,000. Okay, so now once we normalize it, we're going to go here. So here we're going to go 0% and 0%. Okay. So now what's going to happen, okay, is, okay, so now this company, this business is reporting 416 things in expenses, okay, 416. But now, so when you do the expense ratio, and you take the expenses divided by your income, so that's a 27% expense ratio. Okay, so usually this is pretty low for like a hotel or an RV campground or something like that. But I just want to show you the idea here around what the seller's discretionary income is. So this column here is actually the seller's discretionary income, the SDE. Okay, so I'm going to highlight that so you can see that. So now the sum of that, there's about $172,000 that falls under the seller's discretionary income. Now you could be like, well, Huong, you have to pay taxes anyway, so you're still going to have some of this. You're correct. Okay, absolutely. So I'm going to have to account for this, which is what I do when I analyze it. After the seller tells me, Huong, you know what? You have $172,000 you could play with. No. Okay, it's not really that. Okay, because I still have to pay corporate taxes. I still have to pay accounting, bookkeeping, all that stuff. Okay, now they also say, well, Huong, you know, you have $122,000 here of salary that you're paying yourself, okay, that you don't have to anymore. Well, here's the thing. I don't want to buy a business that isn't going to pay me. Like I want some sort of income specifically as a salary, not from the income per se, but a separate line item, okay? So even though that salary is discretionary, I still want that income, okay? And then the other one that they normally take out is the debt, because everybody has a different debt borrowing capacity. And so their argument around taking the debt column out is saying, well, Huong, if you bought this business free and clear, you won't have any debt. We have debt because we took out a mortgage, we did private lending, whatever syndications they had to do. So they usually take that line item out. Well, here's the reality of it. If I'm coming in as an investor, I want to leverage. I want to buy a business completely cash, like 100% in cash. Okay. So I normally will take the seller discretionary income with a grain of salt and be like, okay, so yes, I have 122,000 that I need to account for. Usually the debt for me would be higher because I'm going to try and leverage this as a new business at what they're trying to sell for, right? Which they could be trying to sell this for like $4.5 million, $5 million here. So when they bought this, they probably didn't have to pay $4 to $5 million. They probably got it for 2 million, 3 million. Okay. So their debt is actually going to be lower than what I would be paying for debt wise. The other thing to consider with this salary portion is that I want a decent number in there because I don't want to trade my time, my lifestyle to go and work at this place. Yes, I will go there and potentially work there for 6 months to 2 years if I need to learn the business, to bring it up to its max, to expand it, to do what I need to do to it. But at the end of the day, I want to be able to put a clone of me in there to run that business for me. I don't want to be there, right? I sort of want to be on my business, okay? Not in my business, okay? So I want there to be sufficient salary through the seller's discretionary earnings to pay somebody else. And if there's like 30,000, well, I'm not going to be able to find a good qualified talented staff person to replace me at 30,000, right? It needs to be some sort of earning sufficient to hire somebody with that skill set. Okay, so that's the information around the seller's discretionary income. So you want to make sure that you understand what you can pull out and how much you can set aside for hiring staff. Okay, so now the other thing that I got asked when I was trying to explain this to a group was, well, Huong, how are you going to buy a hotel? How are you going to fund the RV grounds, right? Like, how are you going to make your next purchase here? Okay, so let's just say that the purchase price here is 5 million. Okay, so this is the purchase price. So for a business, which is different from a multifamily, you're going to need a bigger down payment. Okay, so the down payment is usually 35, 40%. It's way bigger than what a multifamily is. So you need to have, so let's just say it's $5 million and you times it by 35%. So you need about 1.75 million to do this. Okay, and then yes, you have closing costs, you have potentially just cash available to operate expenses. You definitely need about 6 months to 1 year of cash available to operate, because the last thing you want to do is not have enough money to pay your staff. Okay, like there's $227,000 of staff that you have to pay. There's consumables, there's, food costs that needs to go in here, licenses that you still need to pay. So you do want, which we don't have in here. Okay, so the 1.75. Okay, so this amount, okay, so right now, if you're thinking, okay, well, Huong, do you have $2 million just sitting in cash? No, of course I don't have $2 million just sitting in cash, because that wouldn't be an efficient way of leveraging, okay? So now what you could do to do this is you could raise the money, okay, and bring in joint venture partners, okay? So you're gonna bring in partners where it's like a GPLP structure, or you could bring shares, okay? The other thing that you could do, so you're going to raise funds, okay? You're going to take out loans, so you could do private lending, you could do syndicates, you could do any of that stuff, okay? And yes, you are going to be taking out a first mortgage through a loan with the bank for about 65%, okay? So yes, that's the other thing. Okay, so now the third idea here to get the funds is to leverage your other properties in your portfolio. Okay, so this is what I call debt equity. Now, I think in one of the other sessions, I did do a video on debt equity. So if you haven't seen that one, I'll put a link to it in the description somewhere. So debt equity is equity that's sitting in your current portfolio that you own that you could tap in through a second mortgage or private lending. So you're leveraging another property to bring money to this one. Okay, so that is one idea there as well. And if you want to have a further conversation privately because you've got debt equity and you want to know how to tap into it, reach out to me because I'm doing it for my properties and it's definitely an option to do. Okay, so now, okay, so that's how we're going to raise the funds for this. Okay, so now the other thing I want to comment on quickly before I sign off is that you do want to sit on cash as much as you can for periods of time so that you have it available to use when the market is right for taking action. So this is a big thing in stocks. Okay, you want to sit on as much cash as possible because when the market goes down, then you're in the position to buy. Okay, and when you're doing that from the cash flow game, if you play the cash flow game, you want to buy your stocks as lowest dirt cheap possible and then sell it at the highest amount possible so that you're able to leverage that later on. Okay, I'm being waved at and I'm being told, no, that is not the right comment. Okay, so I have a shy watcher who's not willing to come on camera to explain where I went wrong or where I didn't go wrong. So are you, no, okay. So I'll figure that part out because my understanding is that you want to buy low, sell high. Okay. And if you can, and of course, timing the market is not something a lot of us know how to do. So you want to sit on cash, okay, and buy when the market's low. So it's the same idea within real estate. If you can sit on cash, let's just say $2 million. If you have $2 million available, okay, and you can access it through debt equity, and you can leverage that to buy a $5 million property, okay, and potentially make $122,000 and grow this business and then hire a staff member to work this property so that you don't have to, or this business so you don't have to, that is one way of using debt equity. Okay, so this is what SDE is. So seller's discretionary income, no, seller's discretionary earnings. Okay, so yeah, I always get the income and the earnings wrong. So let's see, what else can I tell you about this? Okay, so that is it. So one last point. So seller's discretionary income, that also can apply to multifamilies. Okay, a lot of times in multifamilies, there are SDEs put in there. Let's say dinners, networking events, those types of things. Those are part of seller's discretionary earnings because you, in your own operation of a multifamily, you might not do all that networking events and be writing it off. You might not have subscriptions to write off. So there's certain things that everybody puts into their performas, or sorry, to put into their tax packages that they write off because it's a business expense for that business. But you, as the new buyer coming in, you don't have that expense. Okay, that is all I have to say about SDEs. So please, thank you for watching. If you would like to connect with me, please reach out to me either by commenting or booking a time slot in the scheduler. Thanks, everybody. Have a wonderful week.